So this video is all about planning and implementing, which is such a vital process in the whole financial management role. It is not okay for businesses to just go and spend aimlessly or not track their finances at all, because if you don't do this, things can get out of hand quite quickly. So there's a certain amount of steps that the syllabus requires us to look at in the planning and implementing process. This can be broken down and can be done more detailed, but we're going to stick to what the syllabus says. This is the first section of the processes of financial management, and we're specifically looking just at this main dot point here, planning and implementing, and the steps are financial needs, budgets, record systems, financial risks, and financial controls. You can find these 2 points in 2 other separate videos. So the whole process of financial planning is quite a vital one for a business. In fact, nothing can be done in a business without money. And so making sure that you've planned where that money is going to be allocated, whether you need more money, etc., is really important, especially when it looks at determining how the goals in the business will be achieved. Now, we know that every business has a set of strategic goals, whether that's growth, profit, expectations of shareholders, market share, efficiency, a whole range of different things. And those strategic goals can't happen unless you've broken them down into smaller goals. So for example, if your overall strategic goal is to improve profit for the year, there will be a number of steps taken in place in order to improve profit. So for example, we're going to be looking at the retail industry later in this video. So in the retail industry, say for example, Maya wants to improve their profits by 10% this year. Based on their planning, they know that Christmas is their busiest time of the year. So they need to make sure that they are well stocked and well equipped with finance and have planned and allocated their money in a way that they can maximize their sales and minimize their expenses at that time in order to improve profit. So it's really important that this is done. And to your right, you can see a very comprehensive process of how financial planning actually works. The syllabus breaks it down into much smaller subtopics, and some of these are actually quite combined, but just in general, this is what every business needs to do. Firstly, they need to address the current financial position of the business. Now, from marketing, this is very similar to a SWOT analysis that is done, but in this case, the SWOT analysis is done in terms of the finances of the business. You then develop your financial needs, develop some sort of budget, and estimate your cash flows. Those two usually go together quite well. You then monitor what is going on and make a few little tweaks. You have to make sure you have accurate record systems and maintain record systems of financial statements that are easily accessible and have very few errors. You then need to make sure that you identify any financial risks that have occurred or can occur, and then based on that, establish financial controls as well. So a financial risk could be that you have a lot of theft in your store around Christmas time as well. So you make sure that you have allocated a certain amount based on security or something like that. So let's look at it a bit more in depth. In terms of financial needs, this is all about looking at the financial information of the business. So this sort of goes hand in hand with your SWOT analysis that I said before. So you look at all your financial statements, different sales forecasts, weekly reports, all these things businesses do on a daily, weekly, or monthly basis. And so by looking at these things, the business can see where are they lacking money, where have they got extra money. And based on that, they can see whether they need more money and determine their specific financial needs. So your financial needs will be determined by a range of different factors. Firstly, whether you're a large business, a medium business, or a small business. What's the current phase of the business cycle? So for example, if we're heading towards a recession, maybe you need to have more credit, okay? You're unable to pay your expenses because there's less revenue coming in, so you'll need a new line of credit. It depends on your future plans for growth and development, and it also depends on your capacity to source finance, because if you are unable to source it, if you're not a public company and can't sell shares, then this will impact on your financial needs. Budgets are very useful financial documents that are used to predict the revenue and expenses for a particular period of time for a business. And it's really important that a business does have a budget because it can help them to plan their finances. And budgets will include information such as the cash required for particular planned spending. So for example, knowing when you have certain bills that need to be paid, and then you can allocate certain cash flow. If you have cash surplus from one month but don't have any expenses to pay, then you can know to allocate that for the next month when you have lots of bills to pay. It also helps you to estimate the use and cost of raw materials and about the number and the cost of labor required. So if your budget incorporates that you expect that your sales forecast is going to be this much, particularly around Christmas time, for example, it might be particularly high, then that budget will help you to say, well, I need more people on staff in order to make sure that there is enough human resources allocated to that function of the business. There are 3 different types of budgets that you can have. You can have operating budgets, which is more your day-to-day budgets. You can have project budgets, which is your budget for a specific project that the company is looking at. And then lastly, you have your financial budgets. And your financial budgets are these 3 statements below that we are going to look at in a bit more depth. What's really important with budgets is that you are always planning, but you're actually measuring against your actual performance. So you've planned, that's a really important aspect of a budget, but you have to make sure that you go back and actually measure whether you've gone above or below that, because that's going to inform your planning in the future. And as a consequence, you may have to take corrective action. So this is a budget income statement. So it's not a pure budget. It's incorporated, especially in this part here, it's incorporated some of the income statement within it. But this is the main area that we should be looking at here. So what it includes is your sales. So essentially that will be your cash flow that's coming in from your sales revenue. And then you've also got your expenses. So your cash flow and your expenses, they're the 2 key things that you talk about in a budget. And they're looking at things like your fixed costs. These are costs that do not change over time. And your variable costs, they do change over time. And what happens is that you can look at your variable costs and see what you can change as a result of whether you predict that your sales revenue might change or whatnot. You can control and fix up these variable costs as well. The next section is record systems. So record systems are really important that businesses maintain accurate data, and they have it in some sort of record system where it's easy to find the data, it's reliable, and it's accurate and accessible to those who need it. Businesses need to make sure that they minimize errors in the recording process, because if they can minimize their errors, it means that processes will be more efficient overall. A really big example of a negative consequence of having many errors in your record systems could be that if you underestimate your expenses or you undervalue your expenses on a particular, say, the income statement, it could mean that you as a business look as if you have made more profit than you actually have. And when you look at that profit, businesses are taxed on their net profit. So if you don't value your expenses correctly and have an overstated profit, then your business for that year could be taxed more than it should have been. So that's just one way. And all these documents, particularly for larger businesses, get audited and they go through and actually match up. But businesses can actually pay external companies to come in and audit their finances. Small businesses can do that, medium businesses, private, public companies, everyone can do that. Financial risk. So whenever you're making some sort of financial decision, there is always a risk associated with it. And there's always a risk that you're going to lose money. There are some particular areas that you should know that are related to financial risk, namely interest rates. This is especially important for debt for obvious reasons, because you could potentially have a loan and you got the loan on a variable rate and it was very low at the time, but in 5 years it's increased significantly and now all of a sudden your repayments are a lot higher than you initially intended. Exchange rates is very important for overseas debt, in particular when you are converting currencies. So something may look really good overseas and in their currency, but the exchange rate might not favor you when you convert it back to Australian dollars, and you could essentially end up making a loss. Also, if you have debt in another currency, denominated in another currency, then any fluctuations in the exchange rate could actually make that debt be a lot higher in value in Australian dollars than it would be without the exchange rate fluctuation. Economic conditions, we're currently in very volatile economic conditions that will always change your financial risks, particularly in terms of your revenue coming in and your income sources, especially if you have invested and you use some of that investment as a source of income. So economic conditions really affect that. Your financial risk is all about your debt versus equity, which is known as your gearing ratio. So how much is your business dependent on debt as opposed to equity? That will relate to solvency and other issues as mentioned here. And then your liquidity. So this is all about your long-term ability to pay your debts, and liquidity is all about your short-term ability to pay your debts. When it comes to your financial risk associated with where you're investing your money, whether it is in a new factory for your company, whether it's investing in another business, taking over another business, in general, the rule is that the greater the risk, the greater the reward. And in this case, the reward for business is usually always profit. So in order to minimize the risk, you have to, as a business, consider the return and decide whether it's worth the risk. If you're going to put yourself out there and expose yourself to all this risk, but you're only going to receive very minimal reward, it might not be worth it. You need to make sure that no matter what you're doing, you are not stopping your liquidity, and you are not preventing your company from having liquidity in the short term. If you're going to invest your money, you need to make sure that you still have enough set aside so that your company is still liquid and able to pay their short-term debts as they fall due. Other things that you can consider is this concept of diversification. So don't put all your eggs in one basket. If you're going to invest your money in different areas. Don't put it all in the one thing, because if that goes downhill, then overall you'll experience a loss. But then also you can do things such as hedging and implement insurance and take out a premium. And these two we will talk about later in the topic. Now, financial controls. There are often financial problems, including things like theft and fraud, damage and loss of assets. There's always some sort of errors, and there's misuse of expenses account. And what happens is that a business needs to make sure they have financial controls put in place so that they can achieve their goals in the most efficient way. In other words, they don't want these financial problems to occur, and they don't want losses as a result of these. So financial controls is all about ensuring that you have plans that are in place to make sure that these problems don't happen and you have overall success. Examples of financial controls are your budgets, your cash flow and income statements, your balance sheets, and your comparative analysis. So in other words, by monitoring through your financial statements and making sure that you are constantly checking what's going on, and then also comparing your results with other companies in your industries, or comparing it to your previous year, or comparing it to what you had planned. All these tools will give you some sort of feedback on the financial performance, and then you can implement strategies accordingly. So as you can see, this is a case study a bit on the retail industry in Australia, and using information such as retail sales over time can really help a business to plan and implement in terms of their finances. Now, every business will have this for their own specific store. So we're just using this diagram sourced from Trading Economics just as a general sort of look, but every business will have their own. As you can see, the trend in retail sales has been going down over the past few years. So that is a piece of information that businesses will definitely be using. Overall, people are spending less. So overall, the strategies for a lot of businesses in the retail industry is how can we get people to spend more? Now, besides the fact that a lot of this is happening because of economic conditions, there are a range of different strategies that businesses might use. It could be better marketing. It could be differentiation in terms of their product. It could be, decreasing prices overall, a range of different factors. And so this information is really important when planning for the future. If we are looking at Myer, specifically at Christmas time. So Christmas time is a really big time for department stores. So let's look at what's the planning and implementation that goes through Myer just before or in anticipation of Christmas time. So this is the diagram that we looked at before in terms of the different processes in planning and implementation. Firstly, Myer looks at their current financial situation. What are their earnings so far? What are their expenses that they've had? What are their expenses that are coming up? Then they need to determine their financial needs. So in this situation, they'll know that it's the Christmas season, there's going to be more people shopping, so they might need to borrow money in order to buy more stock. And they'll also need to allocate funds towards having more employees. So for example, at Christmas time, Myer hires a whole bunch of Christmas staff, Christmas casual staff. They'll then develop their budgets and estimate their cash flows, and they'll use sales forecasts, such as the ones that we looked at before, to estimate their revenue, and then they'll look at their own expenses to sort of see what's their budget, what are their cash flows going to be at their time. If they're seeing that they're not going to have a lot of cash flow, then they'll need to retain cash flow from previous periods in order to use during this time. Then they need to actually monitor their results and make adjustments accordingly. They need to make sure they're maintaining accurate record systems. So they'll constantly update their sales results and make them visible and accessible to staff. Now that's also a really motivating human resource strategy, making sales results accessible to staff. You've got to make sure that the data is comprehensive. It's not just a general thing saying, oh, we made $100 million in Myer. It should be, okay, we made 50 million in toys, because that's really where a lot of the money was spent, 30 million here and 30 million there. But if they do this and break it down into different areas, that can help them to plan for their next year and realize, okay, we had lots of sales in this particular area. That's where we need to allocate more of our financial resources. They need to use their recorded data to see, are they behind schedule based on their budgets and based on their plans that they had at the beginning? Are they at risk of losing their liquidity? Are they at risk of insolvency? Do they need to boost their sales? They need to boost their sales. They've realized not as many people are coming in. Boom, let's have a super weekend sale or something like that. So they're identifying risks that are at play and then actually doing something and placing measures, which is the establishing financial controls, in order to improve any downfalls. So that's a really good example of planning and implementing.